Well, it has finally happened. The United States and Israel have launched coordinated strikes on Iran, and Iran has already responded with missiles and wider retaliation. The Iranian response targeted all U.S. bases in the Gulf, except for U.S. bases in Oman. Iran launched missiles at Kuwait, Bahrain, Qatar, Saudi Arabia, Jordan, and the United Arab Emirates, where the U.S. has squadrons of advanced fighter jets, and appeared to hit the U.S. Navy's Fifth Fleet. The energy, maritime, and trade sphere represents a strategic lever with far-reaching global consequences. Oil and gas installations in the Gulf states could become targets of either direct or indirect attacks. Substantial damage to these facilities could disrupt the global energy market, trigger sharp price spikes, and intensify international pressure to de-escalate the conflict. Additionally, interference with maritime transit through the Strait of Hormuz, through which a substantial share of the world's seaborne oil and LNG flows, could function as a significant lever of pressure even without a complete blockade. Similarly, Houthi strikes on vessels in the Red Sea could broaden the geographic scope of the conflict and disrupt global supply chains. This will be treated by global markets as one of the most serious Middle East conflicts in years, with real fears of escalation. It is worth noting that the Strait of Hormuz has never been fully blocked. While Iran is unlikely to sustain a prolonged blockade, it has the capability to disrupt traffic temporarily. Such tactics would not be unprecedented. During the 1980s Iran-Iraq War, Iran attacked commercial shipping and U.S. naval vessels, prompting President Ronald Reagan to deploy U.S. forces to escort tankers in Operation Earnest Will. More recently, in late 2007 and early 2008, there were repeated confrontations between Iranian and U.S. naval forces. Barring a swift resolution, oil prices will likely see steep increases when trading opens on Monday morning. WTI crude oil prices rose in recent weeks to around $67 a barrel, their highest since August 2025 as investors braced for military confrontation in the Middle East. Oil is the primary instrument affected first, as Iran and the broader Gulf region control a significant share of global crude flows. Roughly 20 to 30% of daily shipments pass through the Strait of Hormuz. If it is blocked, many analysts expect oil prices to rise to between $100 and $150 as early as next week. Natural gas and LNG prices don't always move one for one with oil, but in a broader energy risk rally, higher crude prices can lift LNG and other energy benchmarks, especially if risk aversion drives traders out of equities and into commodities. If you want a deeper look at what to expect in the week ahead, and a better understanding of natural gas price trends and market dynamics beyond the headlines, make sure to join the channel for more in-depth, data-driven analysis. Members get early access to new videos, so you can see the analysis before everyone else. Thanks for being here, see you in the next update.